Why most of our money isn't real. Reverberations have been felt throughout the whole global financial system as a result of the recent failure of Silicon Valley Bank (SVB), which is the second largest bank failure in the history of the United States. During our analysis of this crisis, it has been abundantly evident that the nature of money, as we currently understand it, is not at all concrete. To comprehend the reasons why money is not as real as it may appear to be, it is necessary to investigate the workings of contemporary banking and the wider repercussions of the failure of SVB. In the course of this investigation, fundamental insights regarding the illusion of money and the systemic weaknesses that are inherent in our financial system have been uncovered. Number 1. The illusion of money, the function of a bank. To get a better understanding of why money might be seen to be a form of illusion, we must first investigate the functioning of banks. Conventionally speaking, banks are considered to be safe entities that are responsible for the safekeeping of deposits. This view, on the other hand, oversimplifies the increasingly complicated realities of modern banking. The explanation of the fractional reserve banking system. The bank does not just hold your monies in a vault when you deposit money into your account. Rather, the bank does further processing. Instead, it is based on a mechanism that is known as fractional reserve banking operations. The rules of this system stipulate that financial institutions are only required to hold a portion of their deposits on hand as reserves. Loans and investments are the uses for the remaining funds. When you deposit $10,000 into your account, for example, the bank is only obligated to hold a modest percentage of that amount in reserve, which is typically 10% of the total amount. In this scenario, the bank retains $1,000 and utilizes the remaining $9,000 to make loans. There is an increase in the circulation of money within the economy as a result of these loans, which promote economic activity. In addition, the procedure does not end there. The $9,000 that was loaned out might be used to purchase products or services, and the individuals who receive the money would then deposit it into their bank accounts. The new banks then lend this money back to the previous ones, so perpetuating this cycle. Therefore, the initial deposit of $10,000 that you made can result in a significantly bigger quantity of money being created in the economy as a result of this multiplier effect. The influence of the money multiplier. The phenomenon known as the money multiplier effect illustrates how a single deposit can significantly boost the overall amount of money that is available within an economy. The implementation of fractional reserve banking has directly led to the occurrence of this phenomenon, which is fundamental to contemporary financial systems. Even though this system encourages economic expansion by making it possible for additional loans and investments to be made, it also demonstrates that money is not as tangible or real as it appears to be. In its most fundamental form is a structure that is founded on trust and the efficient administration of credit. An analysis of the failure of Silicon Valley Bank as a case situation. It is abundantly evident that the bankruptcy of SVB serves as a clear instance of how the theoretical characteristics of fractional reserve banking may lead to crises in the real world. To gain an understanding of the collapse of SVB, it is necessary to conduct a comprehensive investigation of the circumstances and occurrences that contributed to its demise. A look at the investment strategy employed by SVB and its failure. The SVB was a well-known bank that catered to venture capital firms and entrepreneurs in the technology industry. SVB went out and bought government bonds at a time when interest rates were relatively low to better manage its assets. Historically, these bonds have been regarded as secure investments since they offer consistent yields over time. On the other hand, the decision made by the Federal Reserve to raise interest rates to battle inflation brought about a dramatic change in the landscape. When compared to bonds that SVB had purchased at lower interest rates, newly issued bonds delivered larger returns when interest rates grew. This resulted in a drop in the value of SVB's existing bonds, which would make them less valuable if they were sold before their maturity date. When the bank attempted to sell these bonds to deal with the growing number of withdrawals, it found itself in a precarious situation. Instability in SVB's financial situation was made worse by the sale of these bonds at a loss, which totaled $2 billion. This resulted in a lack of confidence among depositors, who started withdrawing their money in large quantities, which ultimately led to a bank run. The perfect storm, the contributing factors that led to the failure of SVB. The failure of SVB was precipitated by a confluence of several causes, including the following. 1. Increases in the interest rate. SVB's bond portfolio experienced a direct impact on its value as a result of the decision made by the Federal Reserve to boost interest rates. The lower-yielding bonds issued by SVB became less appealing when interest rates increased, which resulted in significant financial losses for the bank when it was necessary to sell them. 2. The economic downturn. A slowdown in venture capital investment and the economic uncertainty both contributed to a reduction in the amount of fresh deposits that were received by SVB. Businesses that were just getting started, which made up a sizable amount of SVB's clientele, started taking their deposits out to deal with difficulties with their cash flow. 3. Insufficient diversification. The fact that SVB was primarily focused on technology companies and venture capital rendered it susceptible to downturns that were peculiar to certain industries. The impact of economic and financial pressures was greater than it would have been otherwise due to the concentration of deposits from a limited client base. The fallacy of money in the context of a financial crisis. The fall of SVB highlights the false nature of money under our current financial system. Although it is commonly believed that money is a tangible item that is kept in banks for safekeeping, at its core, money is a system that is based on trust and credit. The way that banks function is by utilizing deposits as a means of generating new money through loans and investments. This approach is predicated on the idea that not all depositors will simultaneously demand their money, as well as the faith of those who have deposited their money. The limitations of government guarantees and their other restrictions. Deposit insurance is one example of a guarantee that governments provide to maintain stability and prevent panic reactions. Federal Deposit Insurance Corporation, FDIC, protects deposits up to a maximum of $250,000 per account. Providing reassurance to depositors and preventing large bank runs are the goals of this insurance. On the other hand, this guarantee does not apply to large corporate accounts or firms that have substantial deposits, both of which were heavily impacted by the situation with SVB. The aspects that have wider consequences. Significant insights into our monetary system have been revealed as a result of the failure of SVB and the processes that supported it. The importance of trust as a foundation. All of the components of the banking system are based on trust. Depositors need to have faith that their money is secure and that banks will behave properly while managing their finances. The effects can be severe when confidence is broken, as was the case with SVB. When it comes to the nature of money, a representation of credit and financial confidence, money is not a physical item but rather a symbol of these things. Both the value and the stability of money are dependent on the efficient operation of the banking system as well as the trustability of the individuals who participate in it. Concerning the systemic risks, because of the interrelated nature of the economy and the banking system, failures in one sector of the system can have repercussions that are felt throughout the entire system. The failure of SVB is a prime example of how systemic risks can spread across the wider financial system, having an effect not only on firms but also on individuals. Conclusion: reconsidering money and the stability of the financial system. Understanding the nature of money and banking is made significantly easier by the dissolution of Silicon Valley Bank, which serves as a compelling lesson. Even though money may appear to be a tangible asset, it is a complicated construct that is comprised of credit and confidence. As we traverse these realities, we must acknowledge that money, as it is represented by our bank accounts, is not as real or substantial as it may appear to be. When there is a crisis, the financial system is dependent on delicate balances and assumptions, both of which have the potential to quickly collapse. A deeper appreciation of the nature of money and the inherent hazards that are present in our economic system can be achieved through a better understanding of these processes. If you found this content helpful, be sure to like the video. Subscribe for more insightful videos and updates. And don't forget to leave a comment below with your thoughts or any questions you may have. We'd love to hear from you.